Welcome to the Leafy Podcast, helping real estate investors and entrepreneurs grow. Say hello to your hosts, Jennifer Goglorick and Brian Price, founders of Leafy Legal Services, teaching you how to protect your assets, grow your business, and manage your wealth. Let's start the show.
Hi, everyone. Welcome to Leafy Podcast. Thank you so much for being with us again today. Today, we have Jennifer and Brian on, our lovely hosts from Leafy Legal Services, and they have another guest that we are super excited to talk about and to. And so I'll go ahead and get it over to Jennifer so she can get us started. Hey, Jennifer.
Hey there. Well, today's investor is a passive investor. You know, some days we have days that are very stressful. So the idea of being able to passively or more, it sounds like it's a lot more chill. You know, you passively just make money, right? So I love it. So he's been investing in real estate since 2009. He's done multifamily, single family, vacation rentals. He's been in over 30 passive syndications between 14 different firms. So he is the guy to talk to us about passive investing. And I know a lot of people think about that. They want to invest. They realize the value of real estate investing, but then they watch, HGTV flipping houses and they're like, I don't know how to do any of that. So today we want to welcome to the show, Travis Watts. So Travis, please tell us a little bit more about yourself and Ashcroft Capital, and just welcome to the show. We're excited to talk to you.
Welcome, Travis.
Very excited to be here. Thanks so much, Jennifer and Brian and
Okay.
Tammy.
Yeah, there's a lot
Everybody.
of us out here.
I know. I
We're
got
all
to
here
think of all
today.
these names. Yeah, thanks for having me. So I got started in single family housing. So as many people probably start their real estate journey, just buying a single family home in my own backyard, so to speak. And that was in 2009. So I kind of really didn't have any goals or plans, didn't really know what I was doing, just knew that I wanted to be in real estate, seemed like a good idea. Real estate had just gone on sale. So I thought, what better time?
Mm-hmm.
So dove in, did everything from house hacking, fix and flips, vacation rentals, buy and holds, all kinds of hands-on and active management type stuff in the real estate game. At the same time, I was working 98 hours a week in an oil field job away from home, ended up working overseas. So I had about, that much spare time. And as I kept acquiring properties, it got harder and harder and harder to self-manage and to keep that up. So what I thought would be very scalable, had these big ambitions of, 50 to 100 houses one day. That was kind of my big long-term plan, and not even 20% there. And I'm thinking, I give up. I threw in the towel on the active stuff. So that's where I transitioned into passive investing in 2015.
I don't even know how you did that working in the oil field. The love of my life, who's sitting not far from me right now, he came from the oil field, and they work round the clock. I mean, you literally go and you bunk up with a bunch of other people, and then you're just working for 4 to 6 weeks straight. That is insane that you were able to start real estate investing with actual hands-on investments at the same time you're working in the oil field. How did that work with you?
It didn't. Ultimately, that's the answer.
It didn't. Yeah.
I tried my best, every day off, every 2 hours at the end of the day that I had was dedicated to trying to keep up with that model. I was having to pull in friends and family. I ended up getting some property managers, but still it wasn't very passive. I still had to make a lot of decisions. At the end of the day, even with the property manager, it's, what do you want to do about the roof? Repair it, replace it? How about the HVAC? It needs some help. So it just wasn't a scalable model to me. It wasn't something I could see myself continuing on for, like I said, 50 to 100 homes. So I had to go back to the drawing board in 2015 and kind of establish myself, kind of go back to the basics here, the goal setting, and what is it I really want. And what I found out through that kind of self-discovery was I love real estate, love the tax advantages, love the leverage, love when it is passive. I just don't like being in the business of real estate, managing tenants and having to drive around, take a lot of my time out to do that. So that's where I found syndication investing. And I started, my very first one was in 2015. and I was a little
Wow,
nervous.
that's not long ago.
It's not. So what, 5, 6 years ago?
That's
something
only
like
like
that?
5 years ago.
Yeah.
That's amazing.
Yeah.
You've done so much in just 5 years after all of that.
Yeah, so I really fell in love with the concept, the model to be passive. So what I did is, after kind of seeing that first investment start unfolding, monthly distributions were coming in, I decided to sell all of my single family homes, including the house I lived in. And I just went all in, you know. I'm kind of an extremist in that way, I guess. So I'm a
why don't you
full-time
talk
passive.
about the syndication, you know, purchasing and things like that, so kind of our listeners have a better idea what that means.
Sure. Yeah. So a syndication is basic. It could apply to anything. It doesn't have to be multifamily apartments like I invest in.
Mm-hmm.
What a syndication means, you have a general partnership or a sponsor. That's the team that's putting together an investment opportunity. And then they're going to basically pitch that to passive investors, people who want to, you know, participate in that offering, but not do any of the decision making or any of the hands-on. And so in my world, just to give a practical example, it'd be like a 300 unit apartment building in Dallas, Texas, where you have a general partnership. That would be a group like Ashcroft Capital, and they underwrite, they walk the units, they put together, you know, the slide deck, and they kind of pitch this opportunity to the passive investors who wants to take part in it. I'm a limited partner in this equation. So I would put, let's say, $50,000 into this deal, and I would share in the cash flow and any potential equity upside down the road, things like that. So it's a way to be involved in real estate without being hands-on.
Yeah.
So tell me a little bit about the tax benefits, because a lot of people get into real estate because there's amazing tax benefits, you know, that you can do from owning, right?
Sure.
And then some of the things get a little bit different when you're just passive investing, but yet there are still some very powerful benefits you can get from that as well. So can you tell us a little bit about that? Like when you're pitching someone and trying, you know, or if someone comes to you, yeah, I want to make the leap and I want to do this, but you know, will I still have some tax benefits, or is it going to kill me in the end? What would you say to that?
Sure. Yeah. Great question. Common question. So first of all, not a CPA or tax advisor. So you got to seek your own legal advice there in your situation. But I can speak from my experience from a high level as a limited partner. So as you alluded to, real estate in general holds some really great tax benefits from a high level. So those same tax benefits will apply in multifamily or in the syndication world, sometimes even in a more powerful way. What I mean by that is you might see something that's called cost segregation, where you can hire.
We just did an entire episode with Yoda Weiss on cost segregation and how powerful that is just this week. As a matter of fact, I watched a video on him and I was like, I need to get him on the show. So I reached out on LinkedIn. And I was like, hey, we need to talk to people about this. And what's great about him is that he comes from a career as a teacher. So when he explained it, he was able to explain what actually it's pretty complicated tax, you know, kind of what we do with asset protection and anonymity here at Leafy Legal for real estate investors. And he was able to break it down, because I understand, you know, one side of things when it comes to, as you said, I'm not a CPA. I think I must say that 10 times a day, right? But I get the idea. I can get the gist of it and how it can work for us. So cost segregation, I think that is very important. If you're in multifamily, you can go from paying taxes to paying zero taxes for some time. So so that's something that you utilize there with Ashcroft Capital too, and or limited partners. Okay.
So Ashcroft is a company that will do cost segregation on each of their properties, as many other operators in the space do as well. So go take a listen to that other episode there. I'm sure it's better laid out than I could do. But,
that was good. I love it. I love it when we learn things, because I learn new things and somebody talks about it and I'm not like, you know, going, what is that? You know, or something. I'm like, oh, I get it now. You know, I've heard it before, but now I really understand it better.
Yeah. So there, you know, the takeaway from the cost seg in terms of syndications is that if you own a single family home and that's the type of investing that you're doing, it may not make sense to do a cost seg study just because of the cost associated with it. You may not get enough tax benefit out of just one home to justify that. But when you have a 300 or 600 unit apartment building, it's most certainly worth it, at least in my opinion. So, there are some tremendous tax benefits overall. Yep.
Awesome. Yeah. So when it comes to doing passive things like that, do you have to be an accredited investor to be able to get into something like that? Or is it something that anybody can get started with if they don't have if they're not accredited?
Yeah, that's a great question. Another very common question. So it's a misconception in the industry that every deal out there in the syndication world is only available to accredited investors. Not the case. It depends on the type of offering that the syndication group is doing. So the majority of syndications I've come across have been 506B, B as in boy, meaning that the sponsor could take on up to 35 sophisticated investors that may not be accredited. So sophisticated just meaning they have the understanding and the know-how of what they're doing and the liquidity or the illiquidity of the investment, the risks, all that kind of stuff. Through an advisor or independently, doesn't matter. Now, Ashcroft Capital does 506C offerings, C as in Charlie, so they can only take accredited investors on their particular deals. For anyone listening that's not familiar, it's a accredited investor has $1 million net worth, whether you're single or married, excluding your primary residence, or you can qualify by income, which is $200,000 per year for the last 2 years as an individual, with expectations of doing the same or greater in the current year. And if you're married, that changes to $300,000, same criteria. So, and then there's other regulations out there I'm seeing pop up more and more, like the Regulation A, where you can take an unlimited amount of sophisticated investors. They're most commonly fund structures because of the cost of putting that together, crowdfunding. So no, I mean, the simple answer is no, you don't have to be accredited, but it does depend on the offering in the group.
Okay.
Yeah.
Do you find that in the accredited deals that there's a greater return, or are they fairly equal if someone was accredited versus not accredited?
That's a good question. Not necessarily. What I've found to be true in my experience through, say, crowdfunding platforms, which is basically just a website that you can log into and see all different types of offerings from different groups. These platforms operate by charging a fee to list your deal on their platform. Well, that fee has to be paid for. So somebody's going to be paying it. And what I've seen as a common practice is that usually returns could be slightly lower to the investors because someone's eating that cost, whether it's the investors themselves or the group, and trying to compensate for it. So that's not an absolute by any means. And one thing to keep in mind with syndications is all these projected returns are just best estimates as to what could be achieved in the future. They're in no way, shape, or form any kind of guarantee or promise or anything like that.
Okay.
And one of the things you talk about is time freedom, like the ability to do what you want, when you want, with your time and different things like that. But there's a calculator you use for that kind of ties into it called your financial freedom number. Can you talk a little bit about that and how people can start to calculate that now that we're coming out of this period where everybody is, I think, like the entire world is maybe doing some reevaluations of where they were at, because it's just forced people to get more inward in many different ways. So tell us a little bit about that calculator, your financial freedom number, and how you can use that now, despite your circumstances, to make changes that are going to be more positive in your life.
Sure. Yeah. So not a financial advisor or anything, but I'll share with you what I use and kind of what I do. So what gets thrown out a lot in the stocks, bonds, and mutual funds world is this 4% rule. And you hear that all the time. And in the FIRE movement, we may talk about here, is also the 4% rule that keeps coming up over and over. The idea behind that, as it applies to, let's say, stocks, for example, is that you have your entire nest egg in stocks, bonds, mutual funds, and at retirement age, or whenever you choose to stop working for any reason, you're going to start withdrawing 4% of your portfolio. Usually that's going to be selling some of your stocks equivalent to 4% a year to live on that. And the idea being that some years in the stock market, it could go up 20% and others could be down 12%, but 4 they found to be a very conservative number. Now, when it comes to real estate and syndications and the types of things that I'm involved with, I've found because I'm such a cash flow focused investor and my investments are illiquid, I can't just be selling 4% of my shares in these because they're not publicly traded. I look at the cash flow, and I've created what I refer to as the 8% rule. And I came up with 8 by looking at my entire portfolio, all the projects I've done, and looking at how much cash flow I'm collecting year to year. I found 8 to be a conservative number for me. I've got some that are slightly below because I just got involved with the deal, so it's kind of ramping up. I've got some into the double digits with cash flow. So here's the simple math behind it. If you use the 8% rule, let's say you want 50,000 per year in passive income to supplement your other income streams. So you would take 50,000 times 12.5. It's always going to be 12.5 equals, that's how much money you need invested at 8% cash flow to live on 50,000. So it'd be 625,000 invested. So this is a game, a strategy that does require a fair bit of capital. So a lot of people ask me, if you were to start over again in 2009, would you be a passive investor? No. I would be focused more on equity and trying to build up a little bit of a nest egg first so that I could go put that to work passively like I did, to where the result actually made a big impact on my bottom line. It wasn't $50 a month passive income. It was, 5,000, for example.
Yeah. That's good to know, is that, you're recommending someone to go active first and then kind of, build a portfolio, then work on going passive, I think is a great suggestion. That, it's not like you could just stick money in slowly. I guess you could do it that way too, slowly put money in, but it's probably not going to go very quick. So to get to that level definitely is, starting off active, I think is great.
Yeah, I know myself, I wouldn't have been motivated if I would have had $50 a month cash flow and then 75 a month and then 100 a month. There would have come a time I pulled the plug and said, this is too slow on board. I'm going to go do something else. Good point. I think, I don't know what the number is. It's different for everyone, but call it, $500,000 or something. When you invest that at 8%, you start seeing an actual impactful number in terms of passive income.
Absolutely.
So the idea is just to pick your number, multiply it by 12.5, and then that's the number you need to think about for your passive investing, that you need to get into good deals, right?
So first it's kind of identifying what would be the appropriate number for you to live on, obviously different for everybody, but, and then it would also depend on your other investments and whether you have IRAs, 401ks, pensions, Social Security. There's a lot of
still
factors.
Working. Your number might be a lot less at first, because you might go, look, I love working, but I'm going to build this up slowly. I can see that being more scalable for people in their 20s, 30s, 40s, 50s who are still working, because then they can come up with a little number like, what's an extra 20 grand a year? That would be 2 full family vacations.
There you go.
That's a life changer just to do it like that, right? I mean, as far as quality of time and doing things, or that could be, we're going to redo this one tiny bathroom. We're going to increase the house or whatever value you have. You're right. Everybody's different. It just
everybody's different and what you do with it. Yeah. The concept of time freedom is kind of an interchangeable term to financial independence, financial freedom. It's the idea that when your passive income exceeds your living expenses, you now have the freedom, or the freedom of choice, let's call it, to pursue what you want to pursue, to move to part-time work, to retire. Everybody's different, but it's kind of what would you do if money weren't the primary objective? That's kind of the question.
I love questions like that, because there's that one book, Who Moved My Cheese? And that one question and then it had many questions. It was a very valuable book, but one of the things was, what would you do if you were not afraid? And I know that, fear is very, very limiting belief when you think about it. Well, if I wasn't afraid of this, this, and this, I would go, forward, and I'd be the artist I always wanted to be, or whatever it is, It's amazing how that can work. So tell us a little bit about the FIRE movement. What is it? What does it mean? You mentioned it earlier. Explain.
Sure. Yeah. The FIRE movement is an acronym for Financial Independence, Retire Early. I didn't know what this was till a couple of years ago, but my background is that I was raised by 2 very frugal parents who went very hardcore on the saving and budgeting side of the coin, but they were not investors in any way. So I learned a tremendous amount about living below your means and using coupons and buying the off-brand, that kind of stuff. What I didn't know, though, was investing until I got started in '09 through current. So the last decade, that's been my focus. So when you kind of combine these two concepts, this is where the FIRE movement can make sense for a lot of people. So it kind of breaks down, I guess I break it down into 4 steps. These are kind of this is my version of the FIRE movement, but it's basically step 1 would be make as much income as you can make using your highest and best skill set. For some people, it's doctor, dentist, lawyer, attorney. For others, it's a side hustle combined with their primary focus, whatever it may be for you. Do the most you can and basically hustle for a short period of time in your life. Let's call it 5 or 10 years max. Then number 2, it's live on as little of that income as possible for the same time frame. It's not a forever philosophy. It's just, let's say 5 or 10 years, you're going to live below your means basically. And then 3, you're going to take the difference between what you're earning and what you're living on, all that savings, and you're going to push it into investments. Where I differ with the FIRE movement is I would push it into passive investments. That's what I've done because of cash flow and not capital gains maybe one day in the stock market or something like that. Number 4 is avoiding bad debt, credit card debt, personal loans, if you can, student loan debt, all these kinds of things. And if you have those debts, then just paying them off as quickly as possible to get on your way in your life. So I did that for a very long time. That's what kind of brought me to the financial independence or the time freedom a lot quicker than what most people achieve, because most people are setting themselves up to retire in their 60s because that's where Social Security hopefully is. That's when you can start tapping into your Roths and 401ks and IRAs and all that kind of stuff, and pensions if you're lucky enough to have one of those. And so I've just taken the focus to say, hey, I want this stuff sooner than later. So why not retire in your 40s versus your 60s or 70s? That's what the FIRE movement's all about. You've got a lot of people pushing money into like index funds in the stock market, but that's kind of where I differ and say, how about real estate and cash flow instead?
Right.
Yeah. Absolutely. Well, I love that. And we were on, I wanted to make sure that, we did Entrepreneurs on Fire and part of the Fire Nation for that. And we did an estate planning masterclass because we do it with a little twist. Don't plan for your death. You want to plan for right now. And especially the people that have the right estate plan, if anything happens to you, your business keeps on chugging along because it's not going to go into anything that's contested. Right. So it's important to have these things in place. So we talk about this a lot, but it's great to hear your explanation of it. So I was kind of fishing and you did a very good job. So thank you so much. So that's great. Well, we're getting back to the end of the episode a little bit, but I wanted to just see, Brian, if you had any other follow-up questions while we have Travis online. We've got him on our hook here. We can get his brain dump for us.
Yeah. Well, I mean, one is how can we get a hold of you if people have questions directly for you? And any kind of parting words of wisdom that you want to, give to our audience of either getting started or expanding or anything like that.
Sure. Yeah. I spend my weeks doing 15-minute to 30-minute phone calls with people just completely openly. These aren't paid consultations or coaching or mentoring. This is just Q&A. Mm-hmm. If you have questions about passive investing, whether that's syndications or not, anything we've talked about on this podcast, happy to just share from my own experience, lessons learned, point you in the direction of resources, books, seminars, whatever it may be that I've found to be beneficial. Mm-hmm. The way to reach me is ashcroftcapital.com/connect with Travis. And you can set up that call there. And I've got some resources on there too that you can download. And then, words of wisdom. I wish that I would have started with my goals better clarified when I jumped into real estate, when I started investing. Honestly, I didn't know what I was doing. I was just hoping things worked out and just putting my hands in everything and just experimenting, which is great. It's good to experiment, but I guess experiment with purpose, have a why and have a reason for what you're doing. Because I could have saved myself years of time just by having a little more clarity around that.
Yeah.
That's really good. And also too, I would just want to, for anyone who's late to the game, because there's going to be investors that are coming here and you're like, I'm 50 years old. I don't have this time. This is, they're wanting to check out. Any time is the right time to do it. And I think that just by listening here, listen to experts, don't stumble around. You don't have to do it alone. I know that concept, pave your own way, blah, 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 stumble in the darkness. It doesn't have to be that way anymore. There is a wealth of really good information. There's people like Travis you can call and talk to, and that may be able to flip a switch to where you make a goal and plan to do something active or finish working, and then maybe start to get your number, and then move forward. There's so many ways you can change your life. Just do it today. Don't put it off. And know that there's experts like Travis. There's us. There's a lot of people you can call that are just waiting to help you, and wanting to help other people, because that's why we're in it, to make the world a better place. So if you're pausing, just go to ashcroftcapital.com, talk to Travis, and it'll be a great 15 minutes. This isn't even long enough, and I have tons of questions for him. Anyways, well, we got to end. Tammy, you're going to have to take us away. This was great, Travis. Thank you so much for being with us today.
Travis.
You're very welcome. Thanks for having me.
Yeah.
Yeah, thank you so much, Travis, and thank you, Jennifer and Brian, for hosting today. And we will have all of Travis's links in our show notes, so you'll be able to get a hold of him if you have any questions for him. And thank you, everyone, for listening today. Thank you so much. And you can find us on all of our podcast platforms and also on social media. We are at Leafy Legal, and we would love it if you left a comment and a rating for us. And if you do have a question for the show, or you have a guest you would like to recommend, please email me at Tammy, Tammy, at Leafy Legal Services, and I'll get right back to you. Thank you again, and have a wonderful day. We'll see you next time. Bye-bye for now.
Attention real estate investors and entrepreneurs. Did you know that real estate investors are a primary target for lawsuits? According to the National Survey of the Court data, 25% of Americans risk being sued in their lifetime. However, if you are a real estate investor, you have a 95% chance of being sued in the next 20 years. Leafy Legal Services helps you protect your assets and strategically grow your business and wealth. Leafy Legal Services are experts at the Series LLC and Delaware Statutory Trust, two of the newest and most ideal legal structures for real estate investors. Leafy Legal Services have the most personalized and affordable solutions for setting up LLCs. Property owners are always at risk when it comes to their assets. Anonymity is so important. If you own just a rental house and you own your home, you have to protect yourself and your properties from any potential legal issues. Leafy Legal Services have the right solutions to make sure you are happy and feel secure. They offer cost-effective documentation that suits their clients' needs. For a free consultation and ebook, visit LeafyLegalServices.com. They are waiting to hear from you. LeafyLegalServices.com.
Follow us on Facebook, Twitter, and Instagram. Don't wait. Take action now. LeafyLegalServices.com. Protect your assets, grow your business, and manage your wealth.